going to cost. I'm a hypochondriac, so when I'm feeling something weird, I know I have cancer, indigestion or something. And what I want to do today is I want to sort of put that idea into money. So essentially, everybody knows that they should be doing something financially, but you sort of don't want to approach it. You don't want to think about it. You just assume if it's out of sight, out of mind, everything will be fine. And what I do as a financial planner is I sort of force my clients to focus on what they should be focused on from a financial point of view. And so what I want to do today is sort of force you through an exercise that's going to make you have a financial checkup and make you see what are you doing well and what are you lacking. And what we're going to do today is I'm going to make this very quickly, and I want to make it very Q&A. If you have any questions, interrupt me, ask the questions, and we'll try to personalize a little bit. I want you to think of two letters, numbers, people's names, objects, whatever it is. One's going to represent yes, one's going to represent no. And the reason that we're going to be doing this is because we're going to make this very private. The people sitting next to you aren't going to know your answers. You're going to write something down. It's either going to be yes or no based on a letter, symbol, or whatever of your choosing. And all we're going to do is I'm going to bring you through the financial process. This is something that I take all of my clients who are prospects the first meeting, is to walk them through the idea of what financial planning is and what proper financial awareness is. And so I'm going to have some questions for you to answer by yourself in your head to see whether or not you're doing what you need to be doing with your finances. Now with financial planning, you see on your worksheet, there's really only three places that you can put your money. You can put them into what's called cash accounts, insurance accounts, and investment accounts. And we're going to go through the process of focusing on these three things and seeing exactly where you are and if you have either satisfied the need or if you need to work on that need. We're going to start first with cash reserve. So cash reserve is essentially the money that you have on hand that's going to pay for life expenses. Car breaks down, cars explode, kids need something, you need something. Do you have that cash on hand that's going to pay for the uh-ohs in life, the small speed bumps in life? And cash reserve is represented by anything that you can very easily get to. If somebody's been abducted and you need ransom money, can you get to that money tomorrow? That could be checking account, savings account, money that you have under your mattress. Think about how much you have. Now think about your committed expenses. Committed expenses are the expenses that you need to have to keep the lights on, put money on the table, and make sure you have a roof over your head. It's not the fun money. It's not the cable, it's not the vacations, it's not the clothes, it's not the specialties that make us happy. Think about, the first question for you is, what is my monthly expenses? What do I need to pay in order for me to continue my life so I don't have to move in with my parents, eat less attractive food, whatever the case might be? Do you know that number? Your first question is yes or no on that line. Your monthly committed expenses, do you know what that is? Can you say with a surety what you need to spend on a month-to-month basis in order to keep going as is? Now, what is your cash reserve need? How much of that amount do you need to have so that no matter what happens, you're sick, you can't work, you lose your job, whatever the case might be, how much do you need to have in order to satisfy your cash reserve need? This is how you do that. Think about you and your spouse, or you if you are not married. What is your income security? Not your job security. Not what is the likelihood that I'm going to be employed tomorrow, next week, next month. But what is the likelihood that I'm going to get paid? For example, people who are in a sales position, people who are contractors, freelancers, your income security may not be as high as your job security. You might always be able to get a job, but you might not always be able to get paid. In my industry, there's months where I get paid well, there's months where I don't get paid at all. So what is your income security? What is your spouse's income security on a scale of 1 to 10? Take what you think your numbers is, your spouse's is, and then combine it and come up with an average. Take that number, subtract it from 13. That is the number of months of committed expenses that you should have in your cash reserve. So,
Can you do that again?
Yeah.
so think about what is your income security on a scale of 1 to 10? What is the likelihood that you're going to get paid next month, the month after, the month after? Take your husband's. What is his income security? And then average it, whatever that number is. If you feel you're a 6, your husband is a 4, you're a 5. You're a 10, your husband is a 1, you're a 5. Take that number, subtract it from 13. That's the number of months, number of committed expensive months that you should have in cash. Easily accessible by an ATM card, easily accessible in your mattress, wherever you keep your cash reserve.
Can I ask you a question?
Yep.
So is it your husband's income and your income, and then you're averaging the two?
Mm-hmm.
Okay, I just want to make sure that that was the,
Right.
where you're going with
It's the
it.
number between 1 and 10.
1 in 10, whatever you think you're.
Is how likely that, yeah, how secure you
So
are.
if you have a salary job and you are pretty secure that you're going to be employed,
Yeah.
you're a 10.
Yeah,
If you have a secure job or you're in sales,
yeah.
maybe you're a 2 or a 3.
So then you would do whatever between the
10
average
and
of
3s
those, right?
is about 6.5.
So then- You would, what then, how does that relate to what the average of the two salaries are?
So essentially, you're looking at the security of one, the security of the other.
Yeah.
And if you both are paying for this, if you're both helping to put food on the table, your income security is not the best of, it's the average of.
Okay.
Meaning that you want to take whatever his is, whatever yours is, average it out,
Uh,
subtract it from 13, that's how many months of committed expenses you should have.
I'd
Yeah,
say,
go through that pretty quick.
or like backup.
What's that?
I'd like backup or.
As backup. And so essentially, what that's saying is that if one of you were no longer employed for whatever reason, you're going to spend that down to keep life going. And you want to just make sure that if there's ever a situation, contracting, freelancing is the best example, if you go a few months without having steady income, you have that cash reserve to spend down.
So then, just to make sure I understand the math, when you say subtracted from 13, assuming that you said, assuming that you have a steady income, that makes you a 10.
Yep.
Then the answer to cash reserve needed is 3.
Yep. 3 months. The reason being is that you want to have enough in your cash reserve that you are not taking money out of your investments, which we're going to talk about. You're not putting money on credit cards. That's very, very bad. But you also don't want to have so much money in it that you're losing the value of inflation. Your dollar's worth less next year than it is this year. So you don't want to have too much in cash reserve that your dollar is dwindling.
So we're
that's-
looking
that's-
for the number of months that we need reserved.
Yep.
Okay.
Anybody else? So that's cash reserve. So your questions are, do you know your number? Do you know how much you have on hand that you could easily get to? And do you know what your cash reserve need is? And nobody's going to be perfect, by the way. Don't feel bad if you don't have all the answers.
Or any of the others?
Insurance account. So this is for the small speed bumps in life. These are the little bumps. These are the furnace explodes again, the car breaks down. The insurance is for the big speed bumps. It is the what if, the things that my clients don't like to talk about that need to. What if one of you is out of the picture? What if one of you is unable to work? What if you're disabled? It happens. I just had a client just start paying out on their disability case, and she's 27, and she's disabled permanently. So, it can happen. You have health through work. The question is that covering what you're going to need in health expenses? Is it covering your vision, dental? And it's basically what you want to do is you want to find out the premiums that you pay versus the care that you're getting, is it of value? And maybe you don't need as much of a deductible, for example, because you have a healthy cash reserve, maybe you can pay less in premiums. That's also true for property casualty. Some things are required by law, auto insurance, for example, homeowners insurance or renter's insurance, personal property insurance. What you're doing in this bucket is you're taking the risk and you're taking it from you and you're putting it onto a company, whether it's Travelers, whether it's Allstate, whatever that is. Whatever you don't think you can pay, if you think there's going to be a disastrous situation, you can't pay for the effects of that disastrous situation. You want to take that risk and put it onto an insurance company. So if you can't afford not having one of the income earners in the pictures, you want to have life insurance coverage. If you can't handle one of the people being sick and disabled, you want to have disability insurance. Looking at your car insurance. If you can't afford a high deductible, then you want to have a lower deductible and pay a little bit higher in premium. So you want to figure out the math of what could I afford in the case of a disaster versus what do I want to pay in premiums. And it's a very personal conversation. This is a very general conversation, so everybody's going to be different. Two people in a similar situation are going to have very different needs. Then the type of disability and life insurance you have, a lot of people have some coverage at work. Group insurance is always cheaper, but is it enough? So you want to look at it, you want to know what you have through work. You also want to know what your spouse has through work. And one thing I'll say for people is that, well, my spouse has this, I have this, I'm not sure really what he has, whether it's what he has through his employer, what he has in retirement accounts. It's very important that you know. It's very important that you know what your spouse has in available coverage and what types of accounts he has. Another example of a person that I'm working with is an individual who lost her husband in 2010. She became a client thereafter, And we are now 4 years later, and I'm still looking for accounts that he had. They never had a conversation about, I have some money here, I have some money here. And I've spent a lot of time just trying to find those accounts and get it in their name. So even if you don't know passwords, even if you don't know exactly how much or type of account, if you just know, well, through my employer I have this, and I also have some money at Chase, I have some money at ING, whatever the case might be. As long as you know where it is, it's much easier to find it than not knowing and going through state and government agencies to find it. Any questions on the insurance side? Big speed bumps.
For life insurance, when me and my husband bought our house, we bought a policy, and then we ended up canceling it because it was like really expensive per month, and we're both
Life insurance policy?
yeah,
Okay.
and we're both pretty young. And someone told me about like there's a simple life insurance, or what's something that's like.
So when it comes to life insurance, and all insurance is sort of fall under this umbrella, but when it comes to life insurance, what you want to do is you want to think about what is the minimum that I need insured and what is the maximum. The maximum, going that in first, the maximum is all that I would lose. So it's basically where you are now, where you think you would retire. If it's a 30-year span, you want 30 years of lost income covered. That's the high end. The low end is just what do I need to make my husband right. So if you have debt, you want to pay off the debt. And if you have some defined goals like paying for children's education, you want to have enough to pay for that education. So that's the minimum side. Usually people are in the middle. Now what you're talking about is the type of policy, term life versus permanent life. Term life is you cover from year one to year whatever, and the policy is going to be in effect for that term, and if you die within that period, it pays out. After that period, the policy goes away.
Okay.
And then you have permanent insurance, which it sounds like you have. It's a little bit more expensive. It covers your entire life. You can cancel it whenever you want, and what it does is you're paying a little bit more, which goes towards an investment arm that grows, that'll pay for the premiums as they get more expensive.
And this was like if he got cancer or like anything, he didn't even actually have to die to.
That's something more disability.
Okay.
Yeah.
It was it was life and that, so maybe that's.
There
why
are
it's
some combos that are
expensive?
very rare, so it might be that. But what you're explaining is probably a lot more expensive.
Okay, yeah.
And the question comes down to what do you need versus what can you afford.
Okay.
And it differs from person to person. It's just a matter of, it's really what do I want to protect? Do I want to protect the known, year 1 to year 20, or do I want to protect what might happen thereafter? It's all personal preference. And it's what you can afford is the point. Any other questions on insurance?
When you say permanent, like whole life, that's whole life.
Well, that's a type of permanent.
Okay.
Yeah. Probably actually the most expensive of the insurance.
Okay.
Because it has guarantees tied to it, and whenever you pay for something called guarantee, it's much more expensive than different.
You're making me want to sell life insurance. I've been looking for a new career.
Well, what I tell people when it comes to financial planning, so these two buckets and the line underneath is the safety net, because what you don't want to have happen is you don't want to have to take money out of your retirement account to pay for life. And so what I do is I tell people to protect first and then invest. Conversations about stocks, bonds, etc. are way more exciting, but this is much more important, making sure that you have those in place. So again, the questions here, yes or no questions are, do you know what health insurance coverage you have, and do you think it's sufficient? Do you know what you need to have insured through property casualty? Do you have it? Are you paying too much in premiums? Are you paying enough in premiums? Do you have enough coverage? Disability insurance, are you getting enough through disability that's going to cover the committed expenses if you couldn't work? Yes or no? And then life insurance is if you were out of the picture or if your spouse was out of the picture, would there be enough money coming in a lump sum to pay for your goals, whether it be just to pay off debt or to supplement all lost income? Then we get to the fun stuff. The last bucket is the investment accounts. The first part is the available employer plans. Do you know all the plans available to you and or your employer? 401ks, 403bs, employee stock purchasing plan, employee discount plan, distribution plans, profit sharing plans, et cetera, et cetera, et cetera. The first thing to think about is that the employer plans are not just about investing and saving for retirement. They are maximizing your income. How many people have a 401k match that they're aware of?
They don't match.
They don't match. Okay, that is income. The first thing you should be doing is maximizing your match. You should be doing whatever you need to do in order to maximize whatever your match is. Does anybody have an employee stock purchasing plan? You have that as well? Okay, you have a good employer.
I don't, I haven't done.
Okay. You should be maximizing that.
Yeah.
Basically, you should be buying into it, and as soon as you're available, selling it and getting out of it, because it's just extra income. But what you want to do with your employer plan is just maximizing what's available to you for income. It's probably the number one thing you should do when it comes to financial planning. And then eligible retirement accounts, what you have outside of your employer. Are you eligible for a Roth? Are you eligible for a spousal IRA, SEP IRA? How can you maximize what you can save for retirement? Utilizing tax credits, real quick on this. So it's not just about investing. We don't just want to put money in the market and then hope that it does well and deal with things that we can't predict. More so, we want to control the things that we can control, like fees and taxes. Does anybody know the difference between a Roth IRA and an IRA? You do, okay. I have you explain it, you'll do it.
Well, a Roth IRA is not tax deferred, so,
It is.
well, I mean,
It's post-tax.
yeah, post-tax. So, but a Roth, if you have the money there for 5 years, you can take it out without a penalty, and you don't have to be, well, you just have to be of age, right? 65.
Kind of. You're getting into
Okay.
the more detailed part.
Okay, sorry, well,
The simple aspect of it is that an IRA or 401k is pre-tax dollars, gross tax deferred, you take the money out of the ordinary income when you take it out. A Roth IRA is post-tax dollars, gross tax deferred, when you take the money out tax-free. What's the benefit? There's a whole bunch of different accounts that goes into each category. But the concept is, if you think you're going to be in a lower tax bracket when you retire, if you're spending more money now than you are in retirement, you should put your money into a 401k or an IRA, defer the taxes, pay the taxes when you're in a lower tax bracket. If you think you're going to be spending more in retirement than you are right now, pay the taxes now, get the tax deferred growth, get tax-free dollars later. But the problem is you don't know. You really don't know what you're going to be doing in retirement, especially at your age, you're all young, and you don't know what the government's going to be doing. As much as people complain about taxes, we are in one of the lower tax bracket histories ever. In likelihood is it's going to go up over time. So the concept is that figure out what you have access to and utilize everything. Just try to maximize everything that you possibly can. So when you get to a point where you're paying for college, paying for a house, paying for retirement, you have a ton of arrows in your quiver to use, so you can minimize your taxes. And also figuring out what types of accounts and investments are the cheapest to diversify your fees. Yeah.
So if you put money in like a pre-tax plan, does that lower your tax bracket now?
Year one, yes. So it lowers your taxes this year.
Okay,
but then
so
you have to
like
pay
then
taxes
you would
over
get underneath it, you could actually, like if you're right on the border, it's better to put a whole bunch in there and then you'd actually.
right on the border of.
We'll say like the different tax, take.
Well, tax brackets are a little misunderstood. If you're keeping these, let's say that
Yeah,
99, you're 25%, 100,000, you're 30.
yeah,
Your entire income isn't 30, taxed at 30 when you go over that threshold.
okay.
So, short answer, yeah, there is a value putting in pre-tax dollars now to lower your taxes that you're paying this year, but you really want to focus on your 100-year plan. You want to try to utilize tax credits now and tax credits in the future. So you sort of want to have a little bit of access to both. And saying which is better is really dependent on your particular situation. But yeah, the concept, you're right on the concept. And then portfolio management is the fun stuff. The thing I get asked the most when I tell people I'm a financial planner is, what do you think the next big stock tip is? What's going to happen? I don't know, and if anybody does, don't listen to them because they have no idea. And the reason being, very easy example, the stock market just went insane. I don't know if people are paying attention to it. Does anybody know why it went nuts? Ebola. Who predicted Ebola? And no stock picker knows that Ebola is going to happen. In 2011, the Japanese markets had the highest volatility of any market in the history of the market. Anybody know why? Tsunami. Nobody predicted a tsunami, so anybody who predicts what stocks are going to do, they're just lying to. So portfolio management is more about understanding what your time horizon is, what your risk tolerance is, the type of account you're in, how to get the best tax advantage investment in that account, and just making sure that you're utilizing the type of investments that fall into that particular category, and not worry about Apple versus Tesla, for example. Okay?
Is there like a general rule on when you should go from like high risk to low risk, like when you get closer to retirement or what age-ish?
No, and the reason that, yeah, I mean, if you were to do it yourself, for the basic theory is that as you get close to retirement, you want to be a little bit more conservative. But it depends on so many variables: how much money you have, what you're going to be doing in retirement, what your current income is, what types of retirement plans you have, a pension plan versus an IRA, etc. There's so many variables that go into that. So short answer, yes, with a giant but, and it requires personalizing the plan to really understand.
If you have like a pension and IRA, what?
Well, so if you have a pension, if you have guaranteed income that can pay for the committed expenses, you can be much more aggressive with the less guaranteed money.
Okay.
Because you don't have to worry about a downturn in the market because you have this guaranteed money coming in. If you have less guaranteed money, you want to be a little more conservative. So it's person to person, exactly what you should do.
Where does the education 529 fit into?
529 is like a Roth. So
Yeah, but-
post-tax dollars, gross tax, or it comes out tax-free if it goes towards education.
But is that a priority in this? whole
So if I
thing?
had to rank them, so the last thing I'll talk about is what you should be doing. What you should be doing first is maximizing your income. Whatever you have available through work, your match, your ESPP, that's the number one thing you should be doing, maximizing what you have available in income. The second thing is sort of a combination of the two. Make sure that you're fully insured, and part of insurance is making sure that you have enough money on hand. And then prioritizing your goals. So purchasing a house versus retiring, purchasing a second house going on vacation versus retiring, what's priority to you? So it's sort of how you invest and save should be dependent on how you rank your goals. And then unfortunately, I would say education is near the bottom because you can't take out loans for retirement, but you can for school. So while it's important, you should make sure that the only time you can be selfish with your kids, make sure that you're protected and then start saving for them because them having to pay for your retirement is going to be a lot worse than them having to pay for their school. So you should focus on yourself first and then get into the retirement side. So this bucket is, do you know all your available plans, yes or no? Have you maximized your income, yes or no? Do you know what your non-employer eligible retirement accounts are? Have you utilized your tax strategy? And are you taking care of proper portfolio management from a tax standpoint, from a diversification standpoint, diversifying risk, time horizon, political risk, war risk, et cetera, et cetera, et cetera. There's so many variables that go into it. And so the overall question is not just, am I doing what's right, but am I aware? Just like as I was saying at the beginning, once you know that you're not dying of cancer, once you know your car is fine, you feel a little bit better. Once you get to the gym, you feel a little bit better. Going through a little piece of homework, going through the exercise, and just making sure you're aware of what's going on, even if you're not maximizing it, as long as you're aware and you start working for those goals, you're in a much better position than 90% of the country. So, any questions on that? The last worksheet, so obviously I'm doing this for a purpose, is to spread some education, but also to get in front of people who want to know a little bit more. This is very generalized. If you want to personalize or if you have specific goals that you're curious or interested about, if you'd like either a phone call or a meeting, that last page is a way to put that information, and I will contact you. Word of warning, people sometimes are shocked. If you hand that to me, I will call you. It's very odd. Some people are shocked that I call them. If you have a specific goal outside the realm of what we discussed that you're interested in, you've got an inheritance, you have an account that you're trying to roll over, what it might be that you want to talk about, you can write that down as well. What I'd like to do on a phone call, for those who want a phone call, is just to, again, personalize it, answer any questions that you might have. Not necessarily encourage you to come and actually discuss a financial plan, but just answer any questions that we might not have had time for now. And then if you actually want to talk in person, either yourself or you and your spouse, and actually personalize a little bit more and talk about the entire plan, the holistic side of financial planning, where everything ties together, we can talk about that as well. But it's non-committal, it's just a chance for you to talk to somebody one-on-one, and if you want to turn that into a personal meeting, we can do that as well.
You could like look at my husband's, or using all the offer, you can help us navigate that.
Pretty easily, yeah. What company does he work for?
He works for the East Bay SPCA.
Really? So he has a 403B
Yeah.
and profit share?
And he just started there. He moved from, he was at Arsenal and Creek, and so he's only been there a couple months, so he's just getting,
Did he roll over his 401k yet?
He never started his 401k
Oh, okay.
at Arsenal, even though he worked at Gorski.
Okay. Another quick tip: if you're leaving a job, do not roll a 401k into another 401k. I've heard that happen. It's horrible because 401ks are wonderful, but they're expensive. Their fees are expensive. Roll it over into an IRA. More control for you, and it's cheaper. So, but
So yeah,
that
so
would
one
be
of
nice.
the and I guess so much more offers like as far as life insurance, so people sort of
Yeah,
kind of
absolutely.
take like the basic stuff, but I don't really think it has the best for our financial situation.
Right.
Small business owners, I don't know, everything that I have is like,
Right.
we're paying out of pocket.
So the process would be, I'd say, what are you trying to accomplish? What do you have to work with? And I would look at it and say, well, here's the things in that plan you should be looking at. That's sort of how it works. Yep, absolutely. there's several ways that I can get paid,
Sure.
and to explain it now would be a little
Okay.
unfair, that's another situation. I either get paid, some people like to pay an upfront financial planning fee, which is basically to have a guy on retainer paying for advice. I do get paid via commission, whether it's life insurance or portfolio management, and then there's also advisory advice, so a percentage of assets under management. I have the ability to have, I'm licensed to do any of that, so it's dependent on what you're most comfortable with. And I explain what each one is, how it affects you, and you can decide, it doesn't matter to me, whichever way you want to pay. So, yeah, do that.
That's why I was gonna ask you where you work, and I realized, oh,
Yeah, I'm local, Walnut Creek. I don't have cars because we just moved, and my current cars are not, they're against compliant regulations, because.
I do have a question, and I'm gonna bring it up, because like, when we were young, my husband and I feel like I've gotten a lot of this under control in the last 5 years, but what I still can't control is that we have this credit card that we had as college students, that we use to pay for our wedding, and it just sits there, and it's just giant thing, it sucks all my money away, and then I'm like, I don't know.
Just one?
I don't know. There's one giant one, that I can't seem to like
So,
get rid of.
the simple advice is there, and again, it's more, we can get more personal, but
You're
I
not
know what else you're working with.
Okay,
High interest first, not balance, high interest first, and then work down.
so I've been doing that, and then I've been taking it, tell me this is like a terrible idea, but like, I'll get these offers, and then I'll take chunks of it and move it to these 0% interest cards and pay that off.
That depends on the length of the interest group period.
Yeah, well, it's 18 months, so I paid off that chunk in 18 months, and I put that card away in the file, and I wait, and I put on more.
So you already own a home?
I do.
Okay, that might not be too bad. The only thing I worry about with that is that it's gonna beat the heck out of your credit.
I know, it's very interesting game of like going around. Our credit's still really good, but it's just like, I want to get rid of that thing so bad, and I've been trying.
Has the balance gone down?
Yes.
Alright, so it may not be the most efficient. All other rich on
Okay.
Great.
I'm done.
I just wanted to say one thing, it's the finances piece of the, like, being whole, right? And your health and your wellness and all of that is so incredibly huge. And it's so interesting, and I've done therapy with my husband just about our different viewpoints on
Highest
money.
reason for divorce.
They're so incredibly different, the way I think about money and the way he thinks about money. And then having to go and try to like mesh our two worlds, and what do you want to keep separate? And oh, I didn't know you had that, and wait a minute, why are you spending that? Because I thought we said we weren't spending money, and you know, it's like values and all of that. So I would, like, I want to run to Greg right now. I think the first time I saw him, I came home, I'm like, honey, I know, like, I'm getting it, like, I know what you're talking about. Because my husband reads, like, a shit ton of books about investing and finances and blah, blah, and then we try to have a conversation, and we do not speak the same way. It always ends in, like, I don't want to talk to you, and I need a break, and you need to go away. So anyhow, I just want to put it out there that if you're feeling like that at all, that's so normal. And like you said, it's one of the biggest reasons for divorce. And so if you are embarking upon, I think like the call that Greg is extending that to you is huge and probably a really great step in the right direction. Whether or not you could actually afford services, I'm sure he could say, maybe this is a good resource or what have you, or you know what I mean, maybe there is something that you can work out that maybe you didn't think that was possible before. But it's a really huge one that women, and I'm reading a book right now about small business owners and women and finances, typically avoid. We don't look at that stuff first, we look at all the other stuff first, and then we put that last, but it's really a bummer when we do that. Has a huge impact, so thank you so much, Greg.
So I just wanted to say, first of all, thank you so much for joining us. And the exercise that we did before you joined us this morning was a self-love exercise where we were talking about the idea of the fact that whatever your situation, you're never alone. So in the spirit of the fact that we're never alone, I would first like to say that I too am a hypochondriac about just about everything. If I had a cut,
How many cancers have you had?
yeah, that's what I think cancers. And I'm pretty sure that I have chlamydia. I was at one time, let me rephrase. I was at one time pretty certain that I had just about every venereal disease that I had when I took my female physiology class. I at that class, the health center sort of prepares an extra phone line. They offer that class because people like me and Greg would be calling on it. Greg, we're a woman. But in the interest of letting you know that they're not alone, I just want you to know that I think the only yes I felt comfortable putting down there were lots of question marks where I was like, I really don't want to say no, but the only yes that I think I actually put down there was cash on hand, because that's the one I could pull up pretty quickly, like right now on my phone. But otherwise, I was like, holy, I am a little scared that, like, my father died when I was really young, and my mom had to scramble, and like, holy crap, I had to figure out this whole financial picture. And so I know from personal experience that this bucket is truly scary, and when someone dies, it's like, oh my God, you just like still have to